Okay, so like, have you ever checked the financial news and suddenly felt like you're on the edge of your seat?
Uh-huh. Yeah, I know that feeling.
Lately, it's been all anyone's talking about this recession everyone is expecting. And honestly, it has me and a lot of, I think, even experienced investors a little freaked.
Right. It can definitely make anyone a little uneasy.
For sure, which is why on today's deep dive, we're tackling this whole recession thing head on, trying to figure out how to not just survive it, but actually make smart moves with our money when it hits.
Love that approach. And you're right, there's definitely a right way to approach things when it comes to investing during a recession. And it starts by remembering that while recessions, by definition, mean the economy is taking a hit, it doesn't necessarily mean your investments are doomed.
Okay, so that's good news. So if a recession is basically inevitable in the economic cycle, what actually happens in the market when a recession hits?
Okay, well, picture this news breaks that, yep, we're officially in a recession. What's the first thing that happens? Fear, right? Investors tend to panic.
Makes sense, right? Uncertainty is scary.
For sure, and usually that fear translates into a sell-off in the stock market. Everyone's trying to get out at the same time, which causes prices to plummet. Basically, it's like herd mentality taking over.
Yikes. So it's a pretty steep drop, huh? How can investors prepare for that kind of free fall? What should they be thinking about?
So when the stock market is in a roller coaster drop, think of bonds as that super chill friend who stays calm no matter what.
I like that analogy.
When stocks are going down, bonds become really attractive. Why? Because they're typically considered a much safer bet. Plus, they offer a steady income stream, which can be a lifesaver, financially speaking, during a recession.
So bonds are like the stable friend in an unstable market. Got it. What about real estate, though, or commodities? Do those react the same way as stocks and bonds?
Real estate and commodities, that's where things get a bit tricky. They can be a bit unpredictable during a recession. Really depends on the specifics of the situation. Some recessions hit those markets hard, some not so much.
Okay, so a bit of a wild card then. But if that's what the playing field looks like during a recession, what are some plays investors can make to not just stay afloat, but maybe even get ahead?
That's the million-dollar question, right? And it all boils down to being strategic. The first rule of thumb, always, is diversification.
The whole don't put all your eggs in one basket strategy.
Exactly. You don't want all of your investments in one asset class. If that one class tanks, you're in trouble. Yeah. But if you spread your investments out, you've got a safety net.
Right, so diversifying your portfolio is key. Got it. But are there certain types of stocks that hold up better than others when a recession hits?
You bet there are. And these are what we call defensive stocks.
Defensive stocks. Okay, what makes them so special?
These are companies that offer goods and services that people will always need no matter what the economy is doing. Think healthcare people always get sick, recession or not, or consumer staples, think basic food items, household goods, stuff everyone needs all the time, and utilities because, well, people got to keep the lights on no matter what's happening on Wall Street.
Right. Those industries make sense. No matter how bad the economy gets, people still need to buy medicine and keep their lights on. So diversification, defensive stocks. What else should investors be thinking about?
So another great tool for navigating a recession is dollar cost averaging, or if you want to sound super smart, DCA.
I love a good financial abbreviation, haha. But seriously, what is it?
Basically, you invest a set amount of money at regular intervals no matter what the market is doing. Say, for example, you want to invest in a specific stock. So each month, you put in $500, no more, no less. When the market dips, that $500 buys you more shares. When the market's high, that $500 gets you less. Over time, what you're doing is averaging out your purchase price, which minimizes the impact of those market swings.
Wow, that is super smart. It's like taking the emotion out of investing.
It's all about discipline.
I like it. Okay, so we've covered some solid strategies for riding out a recession, but you also mentioned there might be some unique opportunities that a recession creates. Can you elaborate?
Absolutely. When the market takes a tumble, it can actually be a really great time to buy, especially if you've got your head on straight and aren't panicking. Think of it like Black Friday for stocks.
Oh, I like where this is going.
You'll see really solid companies with their stock prices down, not because the company itself is struggling, but because the overall market is down.
Interesting. So it's all about recognizing which companies are fundamentally sound, even if their stock price has temporarily dipped.
You got it. Look for companies with a proven track record of strong earnings, low debt, and consistent performance. They might be down temporarily because of the overall market downturn, but their underlying business is still solid. And that's where long-term investors can really benefit buying those shares at a discount.
It makes a lot of sense, right? Not getting spooked by short-term market fluctuations. So are there any specific things investors can look at to find these potentially undervalued companies?
Yeah, absolutely. When you're looking at a company's financials, really pay attention to their earnings history. Are they consistently profitable? What kind of debt load are they carrying? The less debt, the better, especially in a recession.
Debt is definitely something you want to avoid during times of economic uncertainty.
Definitely. You want to see companies that are fiscally responsible. Another thing to look at is the company's management team. Are they experienced? Do they have a good track record of navigating tough times?
It's like due diligence for companies, right?
Absolutely. It's about looking beyond the stock price and understanding the company's overall health and potential. And this is super important. Don't be afraid to do your research.
Research is key. Makes perfect sense. Now, earlier you also mentioned emerging markets and certain industries as potential bright spots during a recession. Can you tell me more about that?
Of course. So even when a recession hits, there are always certain sectors that have the potential to thrive. A lot of this depends on the specific circumstances of the recession and global events. But for instance, take green energy.
Which has been a hot topic for a while now.
Yeah, and the world's shift towards sustainable solutions, towards green energy, it's not going away anytime soon. So even if the overall economy slows down, this sector could very well keep growing.
It's interesting how certain sectors can actually benefit from these economic shifts.
Absolutely. It's about recognizing the long-term trends and the companies that are well-positioned to capitalize on them.
That makes a lot of sense. So we've talked about strategies, we've talked about potential opportunities. Anything else that our listeners should be keeping in mind as we, potentially head into a recession?
Absolutely. Risk management is crucial, especially during a recession.
Which makes total sense. You want to be extra careful with your money when the economy is shaky.
Exactly. Start by reviewing your own personal risk tolerance. Ask yourself, how comfortable am I with the ups and downs of the market? During a recession, it might make sense to take a more conservative approach with your investments.
Being more conservative, what does that look like, practically speaking?
It could mean maybe reducing your exposure to more volatile investments, at least until the market shows signs of stabilizing. It's like adjusting your sails when the wind picks up. You're not abandoning ship, you're just navigating more cautiously.
Such a good analogy. It really puts things into perspective.
And remember, recessions are a natural part of the economic cycle. Knowledge is power. And by being prepared, by making informed decisions, and super importantly, thinking long-term, you can weather the storm and potentially even come out stronger on the other side.
Love that, because it really isn't all doom and gloom. There's a lot you can do to not just survive, but really position yourself for success, even during a recession. Well, on that note, I think we've covered a ton of incredibly helpful information today. Big thanks to you for breaking it all down for us and hopefully helping to calm some nerves out there. And to our listeners, as always, keep learning, keep asking questions, and of course, keep diving deep. Until next time.